In the dictionary, wealth is defined as abundance. In the context of money, wealth means an abundance of it, and wealth creation is a means of turning this abundance into reality. Depending on the definition you use, wealth can also refer to the total value of all of our assets, such as real estate, cash, gold, stocks, mutual fund units, and so on, after subtracting any liabilities such as outstanding loans. Hello and welcome back to the Finance Guardian channel. The concept of wealth is also relative. We set our own standards of success based on our dreams, which determine whether or not we are wealthy. As a result, if you are able to fulfill all of your dreams, you might consider yourself wealthy. For example, you might dream of owning luxurious sports cars, watches, bags, and garments. A substantial amount of wealth would be required to achieve these dreams. Consequently, if you don't have enough wealth to fulfill these dreams, you should work on growing your wealth to achieve your financial aspirations. So for today's video, we'll discuss how wealth is created. Don't forget to hit that subscribe button and the bell beside it, and let's get started. So what is wealth creation? Wealth cannot be created by simply earning more money. Instead, you need to invest your savings to create a parallel income stream. Wealth creation is the process of utilizing your saved money to grow your wealth by choosing investments that align with your financial goals. In addition to choosing the right investments, you must also allow your investments to grow sufficiently. If you invest early enough, you can maximize the benefits of compounding. The advantage of starting early is the ability to stay invested longer, which makes it easier for them to reach various financial goals. Increasing your investments along with your income is another way to ensure you reach your wealth creation goals. If you are salaried, you would receive an annual raise. By increasing your monthly investments by the same proportion as your annual increment, you will be able to save more each year. How much you invest matters more than your returns, especially when you are just beginning your investment journey. There is no absolute way to create wealth due to the different goals and time horizons of different individuals. For instance, if you are investing for the long term, equity-based investments are more appropriate than debt-based investments. Alternatively, debt and hybrid mutual funds are better suited to short and medium-term investment purposes. What is the objective of wealth creation? The importance of wealth creation can be summarized by the statement made by legendary investor Warren Buffett. If you don't find a way to make money while you sleep, you will have to work till you die. His statement means that one of the key goals of wealth creation is the ability to generate wealth passively by investing previously earned money. In this way, savings grow over time and add to the investor's wealth. At the most basic level, wealth creation involves growing your money to meet different short, medium, and long-term financial goals. Your short-term financial objectives may be to save enough money to go on vacation or to purchase the latest iPhone. Typically, these goals should be accomplished within 3 years or less. Investment goals with a medium-term horizon are usually within a 3 to 5 year time frame. Saving for a new car or saving for a down payment on a house are a few examples of such wealth creation goals. Meanwhile, long-term goals such as saving enough for retirement can have an investment horizon which can extend into multiple years or even decades. If this is the case, you should make sure to build enough wealth during your working days to meet your post-retirement financial needs. As there are different objectives for wealth creation as well as different time horizons, different strategies will have to be employed to achieve such a variety of objectives. Savings and investments. Our experience with the pandemic teaches us that we should work smarter, not just harder. As you accumulate money from your diligence, it's important that you consider where to set aside this money and how to protect it from external influences. With so many financial products to choose from, it can be hard to tell the difference between savings and investments. A savings account is where you keep your cash and can earn interest. Investments are designed to generate greater returns by investing money in other areas like the stock market. It's true that investments can fall as well as rise and that you may not get back what you invested. The potential returns might be higher, but they're also riskier. Yet saving isn't completely risk-free either. The pros and cons of saving. There are a variety of savings accounts available with varying advantages and restrictions ranging from easy access savings to tax-efficient cash ISAs. Even though easy access accounts do not always offer the best interest rates, they do give you the flexibility to withdraw money whenever you need it. Other types of accounts encourage you to save rather than spend. There are many financial institutions that offer a more generous and often fixed interest rate provided your money is left untouched for a specified period of time. Either way, your money is safe in a bank or building society. In the US, it's protected by the Federal Deposit Insurance Corporation, or FDIC, and insures $250,000 of deposits for each individual's account at over 5,000 banks. The impact of inflation. You run the risk that your cash savings will not keep up with inflation if you keep them in low-interest savings accounts. Even if you have a steady increase in cash, your money is worth less in real terms as you buy more things. As an example, consider what you paid for fuel, food, and the utility bills in the past years. Despite the fact that you're buying the same thing, you'll pay a lot more for it now, which illustrates how cash can slowly lose its purchasing power. A recent study has found out that almost 50% of people risk losing the value of their hard-earned savings due to not understanding how inflation affects their money. So, if you want to avoid falling into this statistic, you need to grow your money at a faster rate than inflation. The pros and cons of investing. Like saving, there are many different ways to invest, including investing in funds. Investing usually involves one of two ways to grow your money: through dividends or through capital appreciation, or ideally, through both. In times of low interest, such as those we are experiencing today, investing offers greater potential rewards than cash savings. However, investing exposes you to the risks of the stock market. It's possible for your investment to decline rather than increase in value, and it will fluctuate frequently on a short-term basis. It is for this reason that most investments are made for the long term, to provide time for overall growth and to allow room for recovery from any bumps in the road. In most cases, you can cash out your investment at any time, but it's often better to leave it for at least 5 years before you cash it out. As a general rule, you shouldn't invest any money that you will need shortly. Anything that you will need within a short period of time should go into savings. How to choose the right investment for creating wealth? If you are an investor, you might have a variety of investment choices. Just as each tool in a toolbox is suitable for a specific purpose, the same can be said for investments. If, for example, you need to reach a financial goal within 6 months, you must prioritize the security of the amount invested over the potential return. This is why low volatility investment options like liquid funds and fixed deposits are the best for short-term investing. Despite the utmost importance of investing safely, you need to prioritize growth of your investment to achieve long-term financial goals. When saving for long-term goals like retirement or a dream house, opting for fixed return investments such as fixed deposits, FDs, over equity-oriented investments such as flexi-cap funds is a common mistake. Understanding the risk-return relationship. The amount of expected return is determined by the amount of risk you take with your money when you invest or save. Generally, the higher the expected return, the greater the risk of losing money. Savings accounts at financial institutions, for example, are fully insured by the Federal Deposit Insurance Corporation up to $250,000. The return or interest paid on your savings is generally lower than the expected return on other types of investments. Investments in stocks, on the other hand, are not insured. In the event that your investment doesn't meet your expectations, you may lose money or see the value reduced. Once you decide how much risk you can accept, you can use the investment pyramid to help balance your savings and investments. And you should only climb the pyramid after you have built a solid foundation. The bottom line is wealth creation is a continuous process. In order to achieve your goals, you should make a plan and follow it. Additionally, there is no one-size-fits-all wealth creation solution, as every individual has unique goals, risk tolerances, position, and so on. Therefore, choosing the right investments and savings that can help you reach your goals is key to ensuring you succeed in building wealth over time. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do hit that like button. If you're new around here, welcome to the channel, and please do consider subscribing to remain updated about all of our future videos. We'll see you next time.